Let me just get something clear right now. Hey guys, Braden Hatch again, Loan Depot. Today I want to talk about the difference between the Fed rate and mortgage rates, because I get this question a lot.
Braden, I just heard that the Fed might be raising rates. What is that going to do? What does that do for interest rates?
Let me just get something clear right now that the Fed rate is not the same as mortgage rates. The Fed does not determine mortgage rates or set mortgage rates. There can be some similarities sometimes, but today I want to talk about and really dive deep into what the difference between the Fed rate is and mortgage rates, and also what does determine mortgage rates and how you're going to know if they're going to go up or down if it's something that you want to track on your end. Because again, I'm already tracking it every single day anyway as part of my job. The Federal Reserve does not set mortgage rates. They are not the same. So when they say we're going to be increasing rates, that doesn't necessarily mean that mortgage rates are going up. It means the Fed rate is going up. So let's talk about that. What does the Federal Reserve do? What does that rate affect? The Federal Reserve really affects short-term lending, the way banks borrow money from each other. So that's the easiest way I can put it. For example, most of you guys probably have a savings account. If you've had it for the last couple of years, you've probably noticed that the interest you get paid on that savings account, again, if anything, is near zero, 0.0 something percent, right? That's because the Fed rate is near zero. That's what they're talking about. They're also talking about adjustable rates. So let's say you do have an adjustable rate home equity loan or even an adjustable rate mortgage. The Fed rate can affect those rates because again, it's adjustable. When you're talking about a fixed rate, a 30-year mortgage, that is something different. The 10-year treasury note is really what affects that one the most. Basically what will happen, there's certain things that go on in the economy which will drive investors to put their money in certain funds. Changes to the federal fund might not move the 10-year treasury note. So the Fed doesn't set those rates automatically, right? But what can happen as the Fed does change rates, the market or investors can change what they're investing in, right? So they might want to all flock to that 10-year treasury note. If they do invest their money in that, the higher that goes up, that one is going to cause interest rate on mortgages to go higher because that does affect the 30-year mortgage interest rate. So as more money goes into that and as the 10-year treasury gets higher and those bonds get higher, that's going to cause interest rates to go higher. Now, the other thing you want to look at are the overall mortgage-backed security, additional bonds. These ones are the opposite though. As these bonds do better, as more people invest in these bonds, obviously that's going to create interest rates to go lower. It's the whole supply and demand. You've heard me talk about it before. Everything in the economy is driven by supply and demand, even mortgage rates. Again, as more people invest money into that 30-year mortgage-backed security, that makes it a more likable item. And so obviously we're gonna have interest rates go lower because more people are putting their money into it and it's a safer bet. But as they pull out of it, that can cause interest rates to go up. So we've actually seen this over the last couple of months. We've seen the 10-year treasury yield go up as well as mortgage-backed securities go down. So if you've been paying attention, what does all of that mean? Mortgage rates are going up right now. They're on their way up. Will it stay that way? Obviously, no one has a crystal ball. We've got a lot of predictions out there, but the long story of it is the Fed rate does not affect the mortgage rate. So when you hear that the Fed rate's going up, you don't automatically need to assume that mortgage rates are going up. There's lots of different reasons to refinance. We've talked about that in several other videos. So that's really what you want to look at. Not so much the rate as it is it a good time for you and does it make sense? Would you ever want to refinance out of a lower interest rate mortgage to a higher rate mortgage? Or what if you need to sell that house that has a really low interest rate and buy a new one that has a higher rate? Well, that all comes down to affordability, and those are separate videos. Again, the purpose of today was really to talk about the difference between that Fed rate as well as mortgage rates and how they affect each other. So hopefully this was helpful. If you do want to know anything else regarding mortgage rates, where you see them, if it's a good time to refinance, if it's a good time to buy, those are all separate conversations. Simple reminder, the Fed rate does not affect mortgage rates. It's mostly that 10-year treasury yield as well as the mortgage-backed securities. So follow me for more tips and tricks on how to review the market and see where the future of interest rates are headed. And as always, if you do need to refinance or buy a house, give me a call today. Thanks, guys. Bye.